On Friday, we had the worst day in the market since the COVID drop of 2020, where we saw around $3 trillion wiped right off the face of the stock market. And today we are looking at potentially a much worse day. Just looking at some of the stocks and focusing on the Mag 7, we have Nvidia down in the pre-market negative 9%, as we can see trading at $98. When we have a look at Apple, it is down around 8%, currently right now in the market, $202. When we take a look at Tesla, trading $193, down around 7%. When we look at Alphabet, trading just below 160, down around 4.5%. When we look at Meta Platforms, another one, $460, negative 6% in the pre-market. We can see Microsoft as well. Feels like a long time ago when it was trading at $390. It is down more than 4%. And the final one, we have Amazon sitting at $160, down around 4.5%. Now we'll also show Bitcoin as well. This is down around 15% so far. Just over the last week though, this is downward trending around negative 22%. Now just looking at some of the things that have unfolded over the last few days, we already talked and discussed in detail how Warren Buffett's Berkshire Hathaway sold nearly half of its stake in Apple. So is there something that he has maybe seen that we are just now finding out through the market opening very shortly with a massive drop expected? They currently also hold a record pile of $277 billion after reducing their shares in Apple. On top of that, we have a lot of talks about how there is going to be a very large war that is coming very soon to the Middle East, after we did see Hamas leader dead right there in the heart of Iran. We have also seen many articles bringing this into the forefront. As we can see, it is escalating fast right across every single newspaper. Israel bracing for war. It is something that we can clearly see is a major concern. Interestingly, this isn't the likely reason why we have seen this massive drop. In fact, the Japanese stock market does have its biggest one-day drop as global market rout intensifies. Now, when we do take a look, what we can see here is that the index of leading stocks in Tokyo lost around 4,500 points. As we mentioned, the worst drop in its history, and it has closed down more than 12%. And since early July, as we can see, 25% entering what is called a bear market strategy. Now, across many articles today, you are going to hear a lot around 1987, talking a lot about Black Monday as well. So just bear that in mind. There will be a lot of negativity that you will see across the papers. And just to explain this situation, as it can seem a little bit complicated at just looking at it from a first glance, but effectively, we're just going to talk a little bit about exactly why this is happening and why it is affecting the global market. So we have this article here that does essentially say, explain this as if we are someone who is 5 years old. Now, the first thing to understand is that previously in the Japanese market, you could borrow at 0% interest rate and then effectively take that money, reinvest it with anything that is yielding a lot more than the 0 initial percent. So for example, you go to the bank in Japan, you take a loan of $1 million, and then you are effectively paying no interest on that at all. So you go, for example, to the US market, invest in equities that are generating a nice yield, as well as nice share price appreciation. So that's exactly what it talks about here. You borrow the yen at next to nothing and buy an asset outside of Japan that yields more than 0, also known as profit. Now it says this only works if it meets the 3 criteria, is that 1, the borrow rate remains at 0, 2, the collateral that you do hold retains its value, and essentially the asset that you purchase with your loan makes money, which makes sense as well if you're borrowing at a risk-free rate of 0%. Ultimately, whatever you are buying with that 0% interest, you will need to make money. The issues that we are seeing in the market is that all of these factors are starting to unwind, as we can see for carry traders. So the first one, initially, yes, the interest rate was at 0. What we have noted now, the Bank of Japan raised its interest rates last week to sit around 0.25%, which is up, as we mentioned, from the 0 or 0.1% that was there initially. Now, also we can see here that the higher interest rates place upward pressure on the yen's value. So when we talk about this, so they essentially say this is negative as those carry traders who have borrowed yen to buy foreign assets, now they own foreign currency denominated assets against a yen denominated loan. So talking this through, the yen currency index, which has surged 10% in the past 2 weeks, now means that anyone who has borrowed yen owes 10% more, and on top of that at a higher interest rate as well. So what this effectively means for the traders is that they will have to sell those assets, so say for example they are the US equities, and repurchase the yen to pay back their loan. So what does this do? Well, if everyone is doing this to buy back the loans, this effectively increases the demand for the yen, which ultimately just sends it up even further, and the cycle continues, forcing more asset sell downs and even more buying pressure against the yen, and ultimately ends in what they call a liquidation cascade. So no surprises, the real question will be today, is this the end of the selling, or is it ultimately just the beginning? And that is why we can see risk assets right across the board are taking a tumble. So what was it initially? Well, effectively a lot of people did see the Bank of Japan as a piggy bank for the world's assets. As we mentioned, you're getting an interest rate of 0%, and then you're using that to effectively buy assets that are yielding either nice rates or they are essentially appreciating in price. So an infinite money glitch is what a lot of investors saw this opportunity as, but now investors, as it mentions here, are left with a lot of pain. They are forced to effectively sell all of these equities, buy back the yen, which is just increasing that price even further, causing an ultimate repeat cycle. Now, what does it mean for us investors who look for these opportunities? Well, throughout the episodes on this channel, we continually go through many stocks. For example, this is just Amazon, where just a few days ago we talked about this, our intrinsic value of $226, not dissimilar from Wall Street. Now on the price drop, that is now 41% that Wall Street see. And in terms of a margin of safety, as always, 10% as a minimum, and we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So what this ultimately means, right now you are getting a massive margin of safety on Amazon at around 30% up to $158, $159. So there is a lot of opportunities right now that will happen in the market, but whether or not it goes lower, that is something that you will have to understand in your own investment strategy, whether you want to dollar cost average in or just wait. But again, no one knows the future. It could go down further, or in fact, it could rebound sharply. Another example, Microsoft, our intrinsic value of around $429. It now will have a margin of safety at 10%, $387. So it isn't far off. Been a long time since we have seen Microsoft with any kind of margin of safety. And as we've discussed before, Wall Street, a lot more bullish than us. They have a price target of $504. They consider upside of 29%. Finally then, we'll just also run through Alphabet, and before we get into Alphabet's margin of safety, for those that are interested, on our episodes that we do on a daily basis, we do discuss how we get to the valuation. For example, for Alphabet, we have our growth rate at 10%. Now we have a low, medium, and high. Remember that the low of 10% is lower than the increase to the free cash flow last year and lower than their average growth rate. Then with the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and there we have that undervaluation signal. So we would say this is already a very conservative estimate for Alphabet with just a 10% increase, and that gives a nice margin of safety, 10% up to 169, 15% pretty much around the current trading price, and Wall Street, as we can see, very bullish, $209 with upside of 32%. As always, you can grab a copy of this model by clicking on the pinned comment below and running through your own numbers, whether it's for Alphabet or any other company. We also just want to point out we have released our latest free weekly article. If you want access to this or any other articles, do click on that pinned comment below where you can sign up and read straight away. As always, we just want to let you know our own strategy for today will be continuing to dollar cost average into some very strong companies that we have been discussing quite significantly over the last few weeks. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts, and we'll see you all on the next one.